Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah. For the next 20 minutes, we'll talk about 2 or 3 key aspects around the mutual funds. One recent set of developments, and then a couple of pieces that we picked up either by the queries that some of our viewers have sent or by conversations that we've had with fund managers or CEOs across. Our guests today need no introduction, but Gaurav Rastogi from Singapore and Suresh Sadgopan from Mumbai join in. Gentlemen, both of you, thanks for joining in. Really great of you to be with us today.
Thanks, Neeraj.
Okay, let's start off straight off the bat with the first piece. And there is so much of conversation around what could be done on the debt side, and the opinions vary, I think, along with the interest rates. The question is, as 2 or 3 people made a claim, and I wanted to verify that about the pros or the cons of that. And Gaurav, can I start with you? Floating rate funds. There are some who are big proponents saying that now that we've had a bit of an uptick and the quantum of the uptick may not be as steep and the reaction of yields may not be as much to further interest rate increases, let's try and tweak our debt side investments from what it used to be 2-3 months ago, and the floating rate bonds come into the conversation a lot. What are your thoughts here?
So just a very quick summary of what a floating rate bond is, right? And in which kind of environment it should be used. Then I think everything else just falls from that if you understand that like specifically. So when interest rates are rising, the biggest risk in any kind of bond is what we call reinvestment risk, right? I'll take a very short duration example. You have a 6-month bond, or you have, for example, you have a 6 months bond, but in 1 month interest rates rise, right? The bond price will fall. A floating rate bond, the rate that the bond pays is linked to some kind of an interest rate proxy. Usually it will be a government bond, like a gilt rate or something like that along those lines, right? So what will happen is that in a rising rate environment, it's taking care of that reinvestment risk. Now, to your point, if the view is that most of the rate increase has already happened, then floating rate bond doesn't make much of a sense. Floating rate bond only makes sense when your belief is that in the next 2 years, rates are going to rise by 2 to 3%, and so you face a huge amount of reinvestment risk in a fixed rate bond.
No, I don't even have a view, Gaurav. Therefore, I'm asking you that there is a view that exists that, okay, this may also happen. At the same time, there is a view that, oh, even now floating rate bond funds are great. And that investment idea could be slightly different compared to what existed 3 to 6 months ago. So what's your sense there? I don't have a view.
See, I mean, if I also don't have a view, and calling interest rates is one of the hardest things to do. But if this is something that you're really scared about, then short rate bonds also provide you the same level of security, because their interest rate, it's very low. The interest rate impact on short-term bonds is very low, right? If it's an overnight fund, or if it's an ultra short-term fund, there's very little reinvestment risk there. So it's not just you have to kind of think about floating rate bonds. You can also think about short duration fund if you are not too keen to speculate. I mean, I personally am not too keen to speculate what will happen. So that's another way to kind of play the same environment.
Okay, thanks for that. Suresh, how do you view this?
So can I
view this? Yeah.
Okay. So as far as floating rate bonds are concerned, I completely agree with Gaurav that, if the view is that for the next 1 year, 1.5 years, 2 years, the interest rates are going to go up. I mean, of course, it is very, very difficult to say that. Okay, that is there. But suppose the view is that, it will go up like that for a long period of time, which is possible. You cannot really rule that out also, considering the geopolitical situation and the various other things which are happening out of that geopolitical situation, like interest rate going up, inflation catching up, and probably a recession and things like that. So if that is the case, then probably a floating rate fund may make sense. See, one of the challenges as far as a floating rate fund typically is that, there are not enough floating rate funds which are available as we speak, okay, currently. So, however, as per the mandate given by SEBI, floating rate fund should have at least 65% invested in floating rate instruments. So I mean, so that's, I mean, what fund managers do to cover this is basically they go for interest rate swaps, overnight swaps and all that. They go for that, overnight index swaps. They go for that, and then I mean, fixed income is fixed instrument is converted into something like a floating kind of an instrument. So it's a wire kind of a route, and this will work well when in a rising interest rate scenario. It will not work well, obviously, the other way around. Okay, so it is not a surprise that there are not too many funds and there is not too much investment into a floating rate fund. So coming to your question, Neeraj, is a floating rate fund a good choice? Probably to some extent of the portfolio, it may be something that we can opt for. And I will concur with what Gaurav says. I mean, if we can also look at the shorter end of the debt funds, and we can invest in, he talked about really shorter end, like overnight and those kind of things. Probably, I mean, I would probably go all the way to say maybe low duration money market kind of things also. And as and when the interest rate cycle peaks, or if that is our judgment, at that time we can probably lock it into something else. Can I add one more thing, Neeraj, if you don't mind?
Please do.
So for people who have a real long-term view, there are also longer tenure funds which are available, which will have a roll-down strategy or which will have a target maturity strategy. And for those kind of people who are not really looking at income from that, or they have a typical long-term view and they want a good tax-adjusted return, so these kind of funds also are something worth considering today.
Yeah, the example of a Bharat bond ETF or thereabouts, right? That's what you're trying to say, sir.
Yeah, that is one of them. There are also combinations of SDL and some other products. So that is also available, 60-40. I mean, PSU bond and SDL. So those kind of things are also available. I mean, if you are sticking to the maturity profile and if you are holding it to maturity, you are going to get a certain return irrespective of the volatility. So that's
right. Viewers, keep in mind, I think we've done at least 2 or 3 shows on this. Essentially, if you want to invest with a particular time horizon in mind, and if the maturity of the components in that portfolio of a bond fund happens to tie in with the time horizon then you essentially invest in those funds, and irrespective of what happens in the intermediate period, you will get that annual ticket rate coming in to your portfolio because at the yield that you're parking in. Remember, we've done 2 or 3 shows on this, so you can go back and try and hear about them on multiple mutual fund shows that we've done in the last 3 months. So Jem and both of you, thanks so much for that. Now, there are people who are saying that, hey, we seem to have missed out a little bit on the rally that has happened in the last month and a half, 2,000 odd points. And typically, I'm not saying this is the peak of the cycle or the peak of the market or no, but at peaks, people tend to want to invest in a higher risk profile. So without getting into an argument of whether the timing is right or no, let's assume the investor wants to invest in thematic funds. She's looking for ideas when she's watching the show today. Suresh, can I start with you on this one? Are there thematic funds that you would be comfortable recommending to an investor, presuming that investor has 3 to 5 years or even a slightly longer duration in mind?
See, the world in which we are currently is a very, very turbulent world. And like I said some time back, I mean, there are lots of geopolitical risks which are there. And born out of those geopolitical risks, there are actual hard knocks which we can expect at the economy level, at the common man interest level, inflation level, and all that. So it is very, very difficult to call out at any point in time which particular sector may probably benefit from what is going to happen. So my sense is that I mean, we are not really great proponents of sectoral funds or thematic funds in any case. Okay, for the very same reason. In any market, it is difficult, and in this kind of a situation, flux situation, it is very, very difficult. So I would suggest investors to consider diversified equity funds and allow the fund manager to do the job. I mean, if the fund manager has a view that these 1, 2, 3, 4 sectors are the ones which probably can do well in the next 6 months or 1 year, I think that is exactly what they will do. So I think we should relinquish that that particular choice and give it to the fund manager and allow them to do the job.
Gaurav, may I get you in, and with the presumption that this investor, she is also willing to put in the hard hours to even do the background research on the sector or the theme as well. So Suresh's point is, of course, well taken. For the uninitiated, for people who don't have the time, that may be a better option. But for people who are willing to put in the hours, do you have some things in mind that you can share on the thematic side?
Sure. So, I mean, first of all, I agree to everything that Suresh has mentioned. I think timing sectors is hard, regardless of the amount of time someone is willing to put. They will not put in the same number of hours that a fund manager is putting in, and that's their day job. I mean, assuming the fund manager is doing their job very diligently, which I presume most of them do. But coming back to, there are certain themes which we believe, they're not like sector themes, but I think if you are a long-term investor, your investment horizon is greater than 10 years, you are open to taking volatility, as in like you have gone through one cycle of volatility and you have not sold. Then I think small cap SIPs is always a very good idea. I mean, small cap doesn't get the respect as a theme that it should get. I mean, themes need not be very exotic or very, like a momentum or something like that, right? Themes can be things which are very simple. If you're a very long-term investor, maybe, 15, 20 plus, a value SIP makes a lot of sense. So there are certain, I would say, factors or certain themes which have been tested across multiple markets globally and do a really good job in a very long horizon period with, of course, with more volatility than the normal market. That has to be expected, right? Technology is one sector people can start looking at in terms of SIPs. I think NASDAQ, after this correction, is not as expensive as it used to be. But I would 100% agree, think about broad-based thematics, which have a history of outperformance in multiple markets globally across multiple time periods, rather than focusing on the new thing, right? Like, who knows whether the EV basket will outperform or not? So I think the new stuff, which is the shiny stuff, which probably people focus on more. I would agree with Suresh. I think very hard to time. I mean, we all know what happened with ARKK. The money came in absolutely at the peak, and it was supposed to be the next one that's going to make everyone a lot of money. So. But there are these, these time-tested thematics, maybe boring, maybe not as exciting, but that do work over multiple business cycles.
Gaurav, interesting you mentioned that small caps don't get the respect that they deserve. Do you reckon that most portfolios should have an SIP into small caps and initiated that with a time horizon which is longer in nature for higher gains and more stable gains?
Oh, definitely. I think this problem with small caps is they come into focus only in the peak of the markets. 2017, end of 2017, everyone's launching a small cap thematic basket, and small caps are everywhere. And 2018, January, they peak. Small cap requires that. So that's why I said these are thematics that people should go into, have gone through at least one volatile cycle and have not sold. So it's a very high bar for who should think about small caps. For majority of the investors, I would say Nifty 50, Nifty Next 50, and invest for 40 years and be the best at your day job. Make more money to invest more money to become really wealthy, right? I mean, that's the easiest kind of flywheel that an individual can control. But yeah, if someone has interest and someone's gone through a cycle and they know that, 2018 when small caps started crashing and actually went down close to 60, 70%, but they didn't sell and they kept on buying through that down cycle and they're still investing in that SIP, definitely it's something worth considering.
Suresh, what are your thoughts on mainly the thematic is done, but mainly the duration that somebody should have in small cap before we move to the last topic for the conversation?
Yeah. So typically small caps are recommended only for people who have high risk appetite, long investment horizon, and the stomach for volatility. So, I mean, so basically these three things are, I would say, important ingredients. I would also say that, I mean, they should invest in with a fund manager who has enough, you can say, track record, a good picking style as far as small caps are concerned. Because in small caps, it is all about stock picking and probably shuffling the stocks as you go along. So that's very important. So if one has the risk appetite and one is willing to stay for a long term, then I think small caps are fine in a SIP mode.
Okay. Gaurav, final conversation, and that is on, I mean, did anything in the AMFI data stand out for you? I mean, I think the equity flows and equity SIPs continue to be as it were, but did anything stand out for you?
It's fantastic data. I think people are looking at this data and they're like, oh, in July, equity inflows are down 42%. I think what a lot of people, and I think sometimes we are also, very critical of the retail investor. We miss out on the larger story. The larger story is India didn't have an equity culture. And for the longest time, we used to talk about India not having an equity culture. Now that we finally have an equity culture, we are now arguing on the merits of, is this, are they able to time the market well, or, are they not investing big amounts because, of where the market is. So when I look at AMFI data, when I look at mutual fund inflows since October, I think there was some data that I think Kotak published from October till July. FPIs had sold close to, let me quickly get that, sold close to 250,000 crores. That was the net investments of foreign investors. And mutual funds, so investors through mutual funds bought about 197,000 crores, right? So this is what the retail is showing is finally an equity culture. Right? This is what equity culture will look like. What you want equity culture to look like is to people to buy in up markets, people to buy in down markets, people to buy in sideways markets. And for the longest time, that is what we have been saying, India doesn't have an equity. Now, when we finally have an equity culture, I mean, looking at this data and kind of like minutiae and trying to pick points on it, at least I think I look at this data and I only see good things.
Okay. So you only see good things. Suresh, for you, did something stand out?
Yeah, as far as equity investments are concerned, there can be, say, maybe some highs, lows in certain months. And we want to say that it is down by 42% compared to the previous month. But the fact is that it is positive. In such a turbulent situation also, it is positive. So I would say that is very, very good. I mean, overall, it bodes well for the investors per se. The second thing is, if you look at the SIP, people have not stopped the SIP just like that. So it is still hanging over the 12,000 crore mark per month, which is very creditable for all the retail investors. A lot of applause for them. And as far as debt portion is concerned, it was negative 92,000 crores, and now that has also turned positive. So we don't know where it will go. We are not very sure, but it has turned positive, and it bodes well for mutual fund industry as a whole. Mutual fund industry as a whole is within kissing distance of that 38 trillion now. So I think, we don't know, we cannot predict, but I think it looks like it is probably on a march onwards. Because if you look at the India numbers and what we have heard from various sources, it looks like while there are problems, we have reasons to be cautiously optimistic, at least in the near term.
Sure. Okay, gentlemen, I'll wrap this up with something out of the blue, but I'm going to ask you this nevertheless. Gaurav, will start with you. One thing that you saw, which was a deviation from the previous months in terms of investor behavior at Kuvera. Did anything happen which was quite substantial? Maybe people invested a lot more in small cap funds. Maybe people invested a lot more in thematic funds. Maybe flexi cap funds saw a really big surge at your platform. I'm not talking about industry wide, but at your end, because you must be looking at these data fairly minutely. And by the way, you write very well, Gaurav. I get your emails from Gaurav at Kuvera, so that's pretty exceptional. But tell me, what was that one thing that stood out for you?
If I look at the last 6 months, to be very honest, nothing much has changed. We see a lot of investments in our platform, like top 5 funds is usually 2 index funds. Usually there the UTI wins. We did see some small cap activity, but that was last quarter of last year, to be very honest. This year, I think it's gone back to a diversified large cap funds, and mostly that's where we are seeing a lot of the investments coming in. what has, I think Suresh mentioned this, what has really kind of shown that people are embracing this volatility in a way that we would want them to, right? We always say long-term investing is all about staying the course. The SIP book hasn't changed much at all.
Yeah.
People are religiously doing their SIPs. I mean, there hasn't been the same growth that we have seen, in the last 6 months of last year. But it's not like, people are kind of closing their SIPs and leaving the investing world in a hurry.
Got it. So no major surprises per se. Steady as she goes. Okay. Suresh, any big change in recommendations that you may have done in terms of funds that people should or clients should or should not invest in?
No, there has been no major change in a matter of, say, last few months that way. In our case, we are into pure advisory.
Of course.
Yeah. So in our clients' cases, it is going to be client specific, their situation specific, their risk profile.
Okay.
And it's going to be based on that. So it's a slightly difficult thing for me to answer this question.
No problem.
But from our side, that nothing really has changed.
Okay, so steady as she goes. Well, I think on SIP flows, on the recommendations, on the investor behavior at Kuvera, or other things, it's steady as she goes, which is probably not a bad thing as well. Just makes the excitement on the show die down a little bit, but that's okay. But gentlemen, both of you, thank you so much for being with us
today. As investing should be, right, Neeraj?
Oh yeah, well, yeah, that I agree. As long as it makes money, let it be boring.
Yeah.
Perfect. But thank you so much, gentlemen, both of you, for joining us today. Really appreciate your time.
Thanks for having me. Thank you.
And viewers, thanks for tuning into this leg of the Mutual Fund Show.